Good morning, everyone. I'm excited to be here with you as we begin part 2 of Bank of America's Business Finance Series. I'm Olivia Rios, Director of Operations and Programs at the LA Latino Chamber. The topic of today's webinar is very critical, for businesses are not always clear on how to grow their business, especially how to qualify for loans. Last week in part 1, we learned the key elements of building business credit. And today, our banking expert, Valerie Rivas, will share the various factors that impact on getting a loan, what to look out for in your business and personal finance picture, and how not to be red flag and how to improve your odds of getting qualified. We have so much information for you that we want to get started right away. And at this point, I'd like to introduce and welcome Valerie Rivas, Vice President, Small Business Community Officer at Bank of America. Good morning, Valerie. I'm so excited to see that you're with us again this week to share the important information that's relevant to our small business owners, especially as we gear towards the end of the year, and how we want to make sure that, come January 2024, we start on the right foot to grow our business.
Hi, good morning, everyone, and thank you so much, Olivia. And I'm happy to be back this morning. So thank you so much for welcoming me back, and everybody who is investing on themselves and in the business to be able to learn a little bit more of how to be efficient on when obtaining credit. So last week, if you missed it, we actually do have a recording that Olivia and her team has put on the LA Latino Chamber of Commerce website. So you're more than welcome to view it so that you are on track with our whole series. So last week, we talked about how to build business credit, how to raise your business score, and business credit best practices. So if you missed it, feel free to go onto the website, log on, and be able to watch the video so that you can learn more on how to do these things. I also wanted to share a little bit of a couple things that Bank of America is doing to give back to our community. One of the things that they're doing is for the LA County area is they are granting $25,000 if you're looking to purchase a commercial property where you want to move in your business. In addition to that, we talked about building business credit and the 532 rule. If you missed it, we're going to go through it today as well. And we also have a $500 bonus on a business credit card that does report to Dun & Bradstreet. So if you're interested in that, feel free to reach out to myself, or we also have Vice President for Small Business Banking, Carlos Gonzalez, who is also part of the LA Latino board. So he's also going to be moderating the chat. So if you have any questions in between, he'll be able to answer. He's also an expert. He's actually one of my mentors as well, which I admire, and he's taught me so much as well throughout my career and the last 5 years that I've known him. So I've definitely learned from him. So you are in good hands today. So just a quick introduction about myself. Again, thank you so much for having me here. My name is Valerie Rivas. I have been in the finance industry for the last 19 years, been serving small businesses like yourself and entrepreneurs for the last 13 years. And I've been with Bank of America for a total of 9 years. I started my education at Cal Poly Pomona here in California back in 2004. And I ended up graduating from the University of Phoenix with a certification in human resources. Just quickly, a couple things about myself. I have a 13-year-old son and a first son. He's a boxer. It keeps me really, really busy. Actually, they both keep me really busy. And my free time, I enjoy camping with my son. And if I don't have my son, I do a little salsa and bachata dancing on my own time. So it's just a little fun fact about myself. And today, I also wanted to share my contact information just in case you are to need anything. And then Carlos, my colleague that's present today, will also share his contact information on the chat, just in the event that you need to speak to any of us. So if you want to go ahead and scan this QR code, you're more than welcome. And I'll be happy to have you, and you're visiting my website, and then also schedule an appointment here. So I'll allow a little bit of time for that to happen. Okay, perfect. So now I'm going to go ahead and start with our presentation. These are what we're going to be talking about. So I think I left out your capacity to repay and how to improve your odds on getting a business loan. Now, as your business grows, or when you're starting up your business or a new venture, there might be situations where you're going to run into the need for capital, and which is why today is so important. Now, every year, Bank of America does a small business owner report. And what that entails is we want to know where our small business owners throughout the country stand, also what some of their concerns are, what we can do better for them, and different things that they're needing throughout the year. And back in 2023, earlier this year, we surveyed over 1,000 small business owners throughout the country that are our clients, and they all expressed concerns on different things. And the reason I'm touching on this today is because it brings up the fact of how today is so important. In 2023, 82% of our small business owners actually mentioned that they were looking for some sort of way of access to capital, whether that's borrowing from a bank, a lender, a CDFI, a family member, which I always say scares me because you could easily ruin that relationship if something were to go wrong, or just taking it out of their 401k. So this is something where today we'll set you up on getting any type of future loans, any type of loans that you might need, or any type of capital that you might need in the future. Now, I wanted to start you off this morning with a quick story that happened to me when I was maybe 18 or 19 years old. My dad had an HVAC company. If you're not familiar with that, they fix air conditioners and also heaters. And if you could think about that, during the summer, they're really, really busy because of the summer. It gets hot, so people don't want to suffer, and they want to get their air conditioners fixed. And then he's really, really busy in the winter time because it gets really cold, and he has to fix the heaters of these homes or commercial properties. And he was pretty much looking to retire pretty soon. He wanted to slow down. He didn't want to be as involved in the business, so he offered me to take over the business. But for me to be able to do that, I was thinking, well, I'm going to need capital. And I remember going to Wells Fargo. They had certain qualifications that they needed. I just wasn't there. I was lost, right? And the thing about it is I just did not know the resources or tools that are available out there in the community to be able to help me. One of those is the CDFIs. So CDFIs could actually help you do a startup loan. You don't necessarily have to have experience in that industry. It's always recommended, but I just didn't know what was out there. So what ended up happening, I ended up passing up an opportunity. And the reason I want to mention this to you is right now we're talking about what the traditional lenders are looking for. It doesn't always have to be this way, but what I do want to let you know is if you are looking for a new venture, you have an idea, or if you want to grow your business and are looking for access to capital, but maybe you don't meet that criteria with the traditional lenders, there is still help out there. So I just wanted to tell you that quick story. I missed an opportunity because I thought I couldn't get access to capital. Maybe I would have been in a different financial situation today. If I would have taken over that business, maybe I could have grown it with the right proper consultations and different guidance from different partners, but I just did not have that information in hand. So I'll leave you with that. And now we're going to get into the 6 C's of credit. So if you did join my workshop last week, we did talk about the 6 C's of credit. And why this is so important is because if you are able to apply this in your business and personal financial picture, you're pretty much in good shape to get lending from the traditional lenders. When I say traditional lenders, is we take a look at lending in a traditional way. So that would be, for example, Bank of America, Wells Fargo, Citibank, US Bank. We kind of all have the same guidelines somewhat. We all have, different niches and things like that. But for the most part, we take a look at lending all the same. So I'm going to go ahead and read each description, and then I'll try to give you examples so that way you can kind of get a full understanding of what each of these mean. So number one is capacity. So typically a business must generate $1.25 of excess cash flow after operating expenses to support each $1 of debt service. This extra capacity provides cushion for a business to absorb unexpected expenses or an economic downturn. Now, what this means, and I want to let you know that this is always set in stone. A lender can look at this differently, but for the most part, this is what we all look at. Now, it does say $1.25 on here that we want to see after every dollar you inject into your business after acquiring the debt. So, for example, if you are borrowing $100,000 and after that $100,000, your payment is, I don't know, let's just say $500 a month. After that payment, we want to see $1.25 of excess cash flow for every dollar that you put in. So that's what they mean with debt service. In addition to that, I did want to say that this isn't always set in stone. It could be a different lender that doesn't need that much of excess cash flow. So I'll give you an example. SBA could give you a higher capacity, meaning that it could give you a higher loan amount. And the reason for that is sometimes they ask for 1.10, so $1.10 or $1.15, depending on the lender, and it gives you a higher capacity. So with different types of programs, you might be able to increase your capacity or you increase your loan amount. Number two, capital. How much capital and what type has ownership invested in the business? Also, does ownership retain an adequate portion of the capital within the business? So yes, traditional lenders do want you to have some money in the bank in order to borrow some money from them. So just a general rule of thumb, I would say something pretty healthy for you to have in your business account is, let's just say your revenue is $1 million, times that by 5%, that would be a good amount for you to have in the business account for us to kind of take a look and see that you have a pretty healthy cash flow. So just think about your revenue, and you want 5% of your revenue sitting in your business account or your personal account, but more so in your business account because it is a business loan. Although I always think about it as a small business owner, it's pretty much one pocket to another, but typically this is what they'll want to see. Number three is collateral. Banks prefer to secure debt with business assets, including accounts receivable, equipment, commercial real estate, and or inventory, all of which can be used as collateral. Collateral, very, very important. So when you come into the bank or you call your banker and say, Valerie, you know what, I need $1 million. We want to know what that's for. Not only because we can get you better terms and better rates, depending on what the collateral is, but also because we can structure it to where you can end up saving thousands of dollars or hundreds of dollars, depending on the loan amount. So I'll give you a quick example. With a commercial property, if you come in and you just say, I want $1 million, and let's just say that your banker doesn't ask you what you need the funds for, which will probably never happen. But if you come in and you say, I want $1 million, and they don't ask you, the most that we could do is 10-year loan. And that's just thinking, it could be different, but that's mostly what we could do without really any collateral. So just think about it. We're pretty much, it's like a credit card, right? We're lending on air. We are hoping based on your credit score that you're going to pay us back. So with that comes a little bit of risk. What that means is you can get a little bit of a higher interest rate, and maybe your terms won't be as good as if you were to tell us what you're going to use those funds for. If you come in and say, Valerie, I'm getting a commercial property, I need $1 million, at that point I would say, okay, we could actually do this over 25 years. So you see how your payment can actually be lower if you tell us what it's going to be used for, and also your interest rate would change. Also, something else to think about is if you have collateral, meaning that it's not a working capital, well, working capital is still, you still have your accounts receivable as collateral, but it wouldn't be as a better rate as if you were to tell us it's going to be used for an equipment where it's actually associated with the VIN number, where let's just say, unfortunately, if you aren't able to pay that back, we can go ahead and grab that equipment and take it away. So that's just one way that you can look at. Number 4, very important, conditions. How do various market conditions, including the economy, industry trends, and environmental factors, affect the business prospects? So an example of conditions is, well, back in 2007, my brother had a real estate business and my other brother had a loan business. So I thought it was a great idea to open an escrow company. Why not, right? We could all pretty much make money if we all work together, and they're going to give me all their escrows. But Valerie didn't do any homework on the market conditions. She didn't realize that the real estate industry on the residential side is a roller coaster. So 2007 was not the best year to open an escrow company, given that in 2008 the market crashed, right? So what happened? Valerie no longer has that business. That business probably lasted like a year, if that, because the market crashed. So it did really well, but then all of a sudden I didn't have enough clients to be able to sustain my business. So very important, you take a look at, 1, what market conditions you're in for your current industry, or 2, if you're looking to open up a new idea or new venture, take a look at that industry and see what it's doing, because most likely if it's being affected by the current market conditions or the economy, it'll be really, really hard for you to get a loan. And if you do get a loan, most likely your interest rate is going to be through the roof, because it's a high risk for the lenders to take a look at lending some money when your market conditions are not all the best. We also just went through a pandemic, right? Not too long ago. And there were certain industries that did really well, and then there was some that did not do really well. So even till this day, they could take a look at that. Okay, if we're to have another pandemic, these are the risks associated if we are to lend this money. So very, very important that, 1, you stay innovative, and 2, you also take a look at what your market conditions are doing so that you can tell the underwriter and have a plan of how you're going to mitigate those factors. Number 5, character. I talked about earlier about, if you're a business owner, it's from one pocket to another, right? So lenders may evaluate business-related attributes like an owner's experience, knowledge, financial competence, personal credit history, and future business plans. They may also look at other individuals who are tied to the success of a business. If you have a business plan, that's actually amazing, because it gives us the direction of where your company is going. And not only that, but as a banker, when we're putting these loans together, you may not see what we do in the back end, but we do our homework to make sure, 1, that you qualify in a cash, based on a cash flow perspective, meaning that your capacity is there. 2, we'll ask you questions like your resume, what kind of experience you have. We want to know what type of experience you have and if you're able to handle the business that you have. We want to know what your credit history, right? So your personal credit report will pretty much kind of tell us how you're going to be leveraging your business credit. So very important, if you have a business plan, just give it to your business banker, because what ends up happening is we're going to pretty much interview you as if we are the ones that are looking at the loan. So we have to put a write-up together depending on what the loan amount is. I've had a company that had a 24-page write-up that we would have to do. Bank of America, I believe, is only 8 pages, but it'll help us get information on how, 1, you run your business, and 2, being able to sell it to the underwriter as to why you are fit to get this loan. Obviously, as bankers, we're always on your side, but we also have to take a look at the risks that are associated with our employer as well. Number 6 was recently added not too long ago. It's communication, and I feel like this should have been there a long time ago, because I can't express how important it is to have a good relationship with, 1, your accountant or your business banker. A business owner's willingness to communicate with their small business specialist is essential to building a productive relationship. The more they share about their history, goals, and priorities, the better positioned they'll be to secure capital. I don't think this is off the press just yet, but we're actually partnering with one of the LA Latino Chamber of Commerce members to be able to give a panel discussion on how your banker and your accountant can actually work together. And you can't imagine how important it is for you to have, one, a good relationship with your banker, and two, to have a good relationship with your accountant. And sometimes, a lot of the times, I've worked with an accountant to be able to get the business owner to the direction that they need to be. Very important that you meet with your banker, I would say at least on a quarterly basis, as well as your accountant. And if you have a great accountant, your accountant will give you advice of when you're ready to do certain things. For example, you're paying $20,000 in this warehouse. Have you ever thought about buying a building? Not only can you depreciate it, there's other tax benefits. So you want that type of accountant. You want that type of banker that's going to guide you on when they feel that you may be ready for these things. Another thing that your banker could do is, while we're running these numbers, they could actually pre-qualify you for other products that may be a good fit. And you got to think about it, right? All the documentation that you're already providing, if you're prepared for it, why not take on that money, especially if you don't need it at that time? That is actually the best time that you can borrow at that time. Also, I do want to mention that throughout my career, those clients that would call me and we would have meetings on a quarterly basis, so sometimes it would be a lot sooner than a quarterly basis. I've had a spreadsheet in where they would tell me, Valerie, at the end of the year, I want to buy equipment. And let's just say on quarter two, we might have a loan origination fee waiver, or maybe we have an appraisal waiver, or we have some sort of waiver that can benefit from them getting sooner than later. Maybe there was a rate reduction. So I would call those clients first before I would call the other clients in my book to let them know of these type of promotions, because sometimes we're not able to email these type of promotions. So that's just another quick example. So here, summarizing back to everything that I said, very important that if you're able to apply all this on your business and personal financial picture, it'll pretty much set you up to whatever it is that you may need for your business when it comes to lending. Now we're going to talk about use of funds and amount of financing. So how the funds will be used. So when you come into the bank and you let them know what you need to use the funds for, we will need to know that, because not only will we be able to give you certain terms for certain products, or also we'll be able to give you certain interest rates based on the collateral that you're using the funds for. So it's very, very normal for your banker to ask you what those funds are going to be used for, because we need to let the underwriter know what the plan is. Underwriters and also the banks and the major banks and lenders, if you are getting a business loan, they don't like for you to use those funds if they're not going to benefit your business. So very important that you let us know what your plans are. Clients will come in and say, I am looking for a working capital loan. Very important that you summarize what you're going to be using all the funds for. So for example, if you're coming in 50,000, I'm going to buy, 25, I'm going to buy a piece of equipment that costs 25,000, and I need 25,000 because I'm going to be hiring an employee. I want to give them a sign-up bonus, whatever it is. Make sure that you let your banker know so that we can go ahead and document that, and pretty much give us an idea of what those funds were going to be used for and how it's going to benefit the business. I had a client that told me, Valerie, I'm ready to buy a water truck. And he did the math and he said, if I am to buy a water truck, I'm going to add an additional $150,000 into my net profit. So guess what I did? I put that on my write-up, because I want the underwriter to know what he's going to be using. And not only that, but he's knowledgeable enough to know what this equipment adding to it, what it's going to do to their business. If you're not sure what type of financing you need, ask your banker advice. That's what we're here for. The amount of financing you're seeking. So it's very, very important that you work with an advisor or your banker or accountant to be able to determine how much money you're going to borrow. And it has to be something that's feasible. So if your revenue is $100,000 and you're looking for $1 million, that could automatically be a red flag. Now, if you choose to submit that amount of money as far as your the loan amount, that's perfectly fine. But that might be looked at as a red flag with the underwriter for something that's not very feasible based on your revenue. So if you're not sure on how much to ask for, make sure to ask your accountant or banker how much to borrow. They're equipped to be able to see how much you can borrow based on your revenue and your financial picture. Your credit profile and ability to repay. So I did promise you we're going to go through this if you missed class last week. So the 532 rule. So this is something that lenders take a look at. It puts you in a great position when it comes to your credit profile when you're looking to borrow or when you're looking for access to capital options. So the 532 rule, what that is we want to see active trade accounts, five of them. Business credit cards, 3 of those, 3 out of those 5, and then 2 paid off in full loans. So that's what we call it the 532 rule. So maintain 5 active trade accounts at all times, simultaneously manage 3 business credit cards, and have pay out at least 2 accounts in full. Now, this doesn't mean that you're not going to get approved if you don't have this, okay? There just has to be other mitigating factors that will outweigh you not having this. So it's still doable, but this will put you in a good position when it comes to your credit profile. The 532 rule would be the most ideal. So some of the ways that you could do this, it could be a loan or it could be maybe your vendor or supplier. We talked about that last week, how your vendor or supplier could actually report to Dun & Bradstreet and give you those trade lines as well. So if you have a supplier or a vendor, make sure to communicate with them, see if they are reporting those. If not, then maybe you can look for another supplier or vendor that will help you in that way so that you can have some sort of credit established. Something else that I can think of that could actually help you would be putting equipment or a vehicle under your business if you're using it for business use. So you're able to refinance that, or you're able to purchase a vehicle under your business. And not only will that become a stronger balance sheet, right? Because now you have an asset that you're adding to your balance sheet, but also you take it out of your personal credit profile and now it's under your LLC or corporation, or under, let's just say you are a sole proprietorship and you have an EIN, you have the option of refinancing into the EIN as well. Your credit profile and ability to repay, very, very important. Your capacity to repay, your application should also demonstrate your ability to repay back borrowed money. So when you come in, you typically, what the banker will do, I'll tell you the process at Bank of America, and this might apply or may not apply to your lender, but typically what we like to do is you come in, we take a look at all your business debt, all your personal debt, and we'll take a look at the amount that you're trying to borrow. We come up with the formula, and then hopefully you're at 1 1/4, or if we're going as an SBA, then we'll take a look at your capacity to repay. If it's 1.15, 1.10, depending if you're going SBA or not, we could take a look at that and give you a recommendation of this is the loan amount that we recommend based on your financial picture. So very important that you work with your banker or accountant to be able to see if you have the capacity to repay based on your financials. Supporting items you may need. So it's very, very normal if they ask you for your personal information. So personal and business tax returns, and we'll get a little bit more into that shortly. Show your business and personal assets as well as cash reserves. So we did talk about capital and we did talk about character, and so now we're going to go ahead and move on to how to improve your odds in an application process. I feel like I keep saying this, but we keep saying this because it's so important to work with an advisor. Make sure you have that relationship with your banker or your accountant that's guiding you through the application process to be able to increase your odds. Gather information before you start. So gathering necessary information before you apply can save time and reduce the risk that you will omit anything important. So below, you will see a list of requested data that might be asked of you. And there has been times where someone comes into the bank and they say, why do you need my personal information? There may be some lenders out there that won't ask for your personal information, but also you got to remember, the way that I look at it is the more information you give the lender, the better rate you're most likely to get, because we're knowing the person that we're lending to, right? So we talked about character earlier. So character, that lets us know what your personal credit score looks like. So that'll give us an idea of how you will be running your business credit score as well. So the more information you provide, the better terms, the better rates that you will most likely get. So information about the business, I'll go through these quickly. Name of the business, tax ID, nature of your business, annual net profit and annual gross sales, list of outstanding obligations, 2 years of business tax returns and personal tax returns. I do want to mention, it says 2 years on here, but there is some programs that do require 3 years, such as SBA, and it also really depends on the loan amount. So if you're borrowing a certain amount, the lender might ask for an additional year just because it is a higher loan amount, higher risk. Information about the owner. So very, very common for the lender to ask. It's not something out of the ordinary. So it is common for them to ask for your personal information, such as name, date of birth, social security number, address, country of citizenship, and residence. Percentage of ownership, personal household income, personal financial statement, and then 2 to 3 years of personal tax returns. I do want to let you know that this is not all set in stone depending on the lender. In addition to that, there are some lenders out there that will take projections. So typically the traditional lenders will take a look at your history, so they'll want to know the past 2 to 3 years, whereas, you know, there are some lenders that will consider your projections for the next year or so, or what your plans are. So just kind of wanted to throw that out there as well, just in case you're seeking lending on a non-traditional lender, they may ask for that information as well. So now we're going to go ahead and recap. So factors that contribute to loan decisions. Keep in mind the 6 C's: capacity, capital, collateral, conditions, character, and communication. I did mention to you that we did go through this last week, and we will continue to do that throughout our series, because it's very, very important that if you're taking a look at getting any type of lending, that you apply this to your financial picture. How will you use the loan? Very important for you to let your banker know. Not only can you get better terms, better rates, but they could also structure it. So I'll give you a quick example. I had a client that I put him on 5 different loans. It was a commercial property, a line of credit, 2 equipment, and a working capital loan. So it was 5 different loans that we put him on, and he was able to save thousands of dollars because it was a large loan amount. But not only that, but I was able to give him different terms on each one, and different interest rates, depending on the collateral. The amount of financing you're seeking. So we need to know ahead of time of how much you're seeking. So very important that you know how much you're looking for and where you're going to be using the funds for. Extra information that I gave you is if you know what that'll do to your bottom line if you are to get the financing. So if you do have that information, make sure that you share it with your banker or the underwriter while you're doing those interviews. Your business's personal credit profile, right? We talked about one pocket to the other. So your business and credit profile, very important that you have good credit on the personal and on the business side, because that'll help you also get better terms and also better interest rate. More than anything, better interest rate. And your capacity to repay. So if you're not sure of what your capacity should be, work with your banker or accountant. We're able to read those numbers on your behalf. How to increase approval odds. Know what you need, why you need it, and how much you need it. Gather your information before you apply, and of course, work with one of your advisors, whether it's your banker or your accountant. Now we're here at the end, so in the meantime, if you want to scan any of these QR codes, I'll shortly go through each one of them and what they do. But closing out, determining credit worthiness beyond the facts and figures. Before extending credit, lenders evaluate a business ability to repay loan on time and frequently require the owner personally guarantee business financing, but determining creditworthiness involves more than just facts and figures. Paying attention to how these 6 factors affect your company credit standing may help ensure you have the opportunity to obtain credit when your business needs it the most. Now, next workshop, what we're going to be getting into is, of course, I can't express the 6 P's of credit. We want this to be embedded, but also we're going to be going through alternative ways of financing. So if you're not able to get financing through the major banks, or you're just not quite there yet and need some preparation, because now that you know this information, you know to work with your accountant and your banker, and you're going to have these meetings with the banker, hopefully Carlos or myself, and then we're able to help you get ready for those larger banks to get those better terms and rates. Now, on these QR codes, the first one is small business resources. So on here, we have some really good resources for our women-owned businesses. And we also have for giving back to our community. So we have that $25,000 grant that I spoke to you about earlier. And we have different offers that are available too, and resources that can help you. 2 is if you want to know more about your financial health, or how, let's just say you want to know more about home ownership. 1, you can reach out to Carlos or myself, or 2, you can go in here and get more information to do self-learning. And then 3, if you want to hear other webinars, so let's just say I was a little too boring for you today, you want somebody with a little bit more energy, or you know, somebody else, another speaker, you can actually go in here. We have pre-recorded webinars, and then we also have ways that you can sign up for different webinars with my colleagues. So with that, I will go ahead and take any Q&A, any questions, comments, concerns.
Valerie, I have one question, well, actually 2 questions. The first question is, during the capacity to repay, you mentioned the bank is looking for a 1-to-1. Is the 1-to-1 the debt service coverage ratio?
Yeah, so debt service coverage ratio is the debt that you are acquiring. So after acquiring that debt, we want to see $1.25 for every dollar you inject to the company, or it could be a little bit lower depending if you're going on a different program.
Okay. The
And
second,
Valerie, if I can just expand on that a little bit. So keep in mind that it's not only that payment, but also any other debts that you have. And some banks look at it, actually, I would say most banks look at it globally, especially for small businesses, meaning that they're going to look at the business debt and your personal debt as well. So this includes things like your mortgages, car payments, any other personal obligations. So it's important to, you know, as Valerie shares this information, if you're thinking about taking out a loan in the future, also, you know, on the personal side, things like, how do I want to manage? Do I want to buy that new car right now? Because that loan payment will be calculated toward your debt service coverage. So just wanted to add that also.
thank you, Carlos. And then we have a second question from Jesse. With high interest rates, what is the time frame when an owner can stop using a PG when requesting a loan?
Every bank ideally wants the personal guarantee. And so it's kind of hard to tell when you can request for credit without a personal guarantee. I guess the most important factor is you want to make sure that you prepare your business to get credit without a personal guarantee. So what does that mean? That means try to leave as much as your business profits as possible on the business side. If you're a business owner that regularly gets distributions from your business and you rely on those, you're probably not setting yourself up for credit without a personal guarantee. And again, most banks are different, but I would say with Bank of America, typically once your business is over 20 million in gross annual revenue, that's when we may consider something without a personal guarantee. But the bank is always going to ask for it. So it's something that you have to negotiate and get the credit without the personal guarantee.
Okay, thank you. And then there's one more question. Under the 532 rule, are the 5 accounts personal or business accounts? Like your personal home mortgage, why 3 business credit cards if the rates are high?
most small business, when a small business applies for credit, I would say most of the time, most banks are going to look at it globally. So again, globally, what that means is we're going to look at personal and business combined. So when you're looking at the trade lines, 5 trade lines with the 3 credit cards and 2 things that are paid off, are we going to see it every time? Probably not. Is it going to disqualify you from getting a loan? Probably not. So as long as it's there on the personal side and you have that strong personal credit history, that will definitely help out. And then to your point, as far as like the Y3 business credit cards with the high interest rates, I mean, keep in mind that you don't have to carry a balance on the credit card. You can pay it off in full. And actually, I don't think any banker would recommend that you carry a balance on it. I mean, you're right; those interest rates are high. There's 30%, I would say, right now. So really, the credit card should be paid in full every month when you get your statement. But what we want to see is that payment history. Hey, this person's responsible. When they get their statement, they're paying it off. I think that's what the bank is looking for.
And then I have a really quick question, and I jotted down this 5 different loans. Doesn't that hurt your credit score and it goes down? But then you answered it by saying, make sure to pay your credit cards on time, pay them in full. There's 5 different areas where they look at your credit history overall. So they'll be able to assess and make a better decision when qualifying for a loan, correct?
Yes, that's correct too. And like you said, 5 trade lines might seem like a lot, but it also depends to how you're managing. And I think that's what banks want to see, how you're managing. If you're somebody that's utilizing your credit 100% of your credit line and you're just doing minimum payments, banks aren't going to feel so good about that. And that's also going to impact your credit score negatively. So that's kind of what you want to stay away from, ideally.
I don't see any more questions in the chat. So Valerie, I want to thank you for the information that you've shared with us, and thank you, Carlos, for your input. I know our partnership with Bank of America is stellar, and we want to continue that relationship moving forward into 2024. I'd like to thank everyone for your participation, for spending time with us, and thank you again.